Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today, I actually have two people for once. This is my first show, guys, with two folks. So I've got Anthony Faso, and he's a CPA, and then also Cameron Christiansen, the founders of Infinite Wealth Consultants and the host of the Infinite Wealth podcast. They're investors, advisors, real estate investors, and they specialize in non-traditional means of building wealth. And so I can't wait to jump into today's subject because I've got some personal interest in it myself. So guys, welcome to the show.
Hey, thanks for having us, Keith.
Yeah,
Appreciate
we're excited to share.
Yeah. And you're dialing in from Las Vegas. But what I always like to start with, guys, is really kind of where you grew up and what got you into infinite banking in this case, and also into real estate investing. So who wants to go first?
Where we grew up. Where I grew up, man, Keith, I grew up in North Idaho. I grew up in a little town called Coeur d'Alene. Beautiful place, but man, if I'm honest, there's not a lot, at least when I was growing up, there wasn't a lot of money there.
There is now.
Now there definitely is. It's people found out about it. But I remember growing up, and the wealthiest guy that I knew was actually the physical therapist in town because he owned the pool that everybody used to go swimming at.
Oh, wow.
And I remember thinking, man, I want to grow up to be Alan, right? I was like, I want to be that guy. But anyways, that is kind of the previous story. I moved to Las Vegas about 20-something years ago, and I started a small business. And it was in that I started looking at retirement programs. I was saving some money and started looking at opportunities that were available for me. And Keith, what I found was there wasn't anything that really suited me as a business owner. Most of the advice, if not all of the advice that I got, was really go put your money into some sort of retirement account that was deferred. And the thing that didn't sit well with me was that I couldn't touch it till I was 60 years old, 59 and a half. Right. And even mid to late 20s, that did not make sense to me. And so, you know what I did, Keith?
What'd you do?
I did nothing, right? Because I did nothing, right? Nothing sounded good. So I sat on cash and I kept making money, and I was looking for a place to put it. And thankfully I came across the infinite banking concept. And it was when my wife and I were buying our house, the broker said, if I'd have read this when I was your age, it would have been the difference of millions of dollars. And he handed me Nelson Nash's book. And that's really what got me going down this road, is I started implementing these strategies just on a personal level for myself and for my business, and then kind of became a resource for other business owners that I knew. And that's how I got started in this business for almost 14 years, coaching and teaching clients on how to implement this strategy. And Anthony and I have been partners for going on 4 years now.
Okay.
Yeah.
Perfect.
So my name's Anthony Faso. I'm a self-proclaimed recovering CPA.
Right.
I'm born and raised in Las Vegas by a single mother, and we never really had much money. But so I was always fascinated about the ability to make money, partly because I didn't have any. Right.
Right.
Then after high school, in high school, I watched Wall Street. right? The movie Wall Street, so now I wanted to be a stockbroker,
Uh-huh.
right? But then I joined the Army, and they don't have much need for stockbrokers. So I went in for infantry. D- d- that was one of the best things that I ever did. When I came out, I really don't know why I didn't get a degree in finance. I got a degree in accounting, and I ended up, once I graduated, I worked for PricewaterhouseCoopers,
Mm.
got my CPA. Then I was a CFO for a chain of restaurants. And then a friend of mine, who's also a CPA, started his own firm. And I wasn't chasing the dollars, but I was chasing the time that it provided. Not having a W-2. I mean, my kids were young, and I really wanted to be more involved with them, especially with my dad not being around. I wanted to make sure that I was around for my kids. So I started a CPA firm from scratch, built that up, and then '08 happened. Now, that was good for my business, because that made everybody's taxes were more complicated.
Right.
So the CPAs are always fine because their government's always changing the tax laws. But what had happened, there was, I remember this older gentleman sitting in front of me, literally almost in tears. He's like, "Anthony, I did everything right. Just what you and my financial planner told me to do. I maxed out my IRA, my 401k. I paid off my mortgage. I stayed out of debt, but now my 401k is a 201k, right?
Mm-hmm.
And I'm upside down in the house. And now you want me to go back to work, but I'm 70 years old. I mean, unemployment's double digits." And what really, for one, it was sad to see that, how that gentleman felt. And the worst part was, it was of no fault of his own. It's one thing, if we make poor decisions and we have to reap what we sow, but it wasn't his fault. It was kind of what's happening in the economy and what the government was doing. And, it got me to thinking that I was on the same path that he was. And I look back, and there was a recession almost every 10 years. And I kind of realized, unless I did something different, why would I expect a different result? So that really opened up my blinders. And I kind of, what had happened is, I went and started, some of my clients actually did very well during that time, right? Most of us got punched in the gut,
Mm-hmm.
but there were those people out there that actually were thriving and increasing their wealth and their income. So I went to them, I was like, "How are you prepared for this? What I was smart enough to ask about the mind, not really about products, but really, what books were you reading? How were you prepared for this?" And they told me about this book called Rich Dad, Poor Dad, right?
Yeah.
Which I had read before. Like, how many people have read it? There's millions and millions of copies sold, but how many people actually put it into action? So this is when I decided to put it into action. And I realized kind of the advice I was getting from my typical financial planner just really wasn't really accomplishing the goals that I wanted to accomplish. And then I had lunch with the gentleman, and he talked about having his own private banking system. And it sounded really too complex, really over my head, but it sounded like they had complex tax returns. So I was looking to get the tax work. And when we had lunch, he was bad-mouthing IRAs and 401ks. Now, Keith, as a CPA, that's like our secret weapon.
Right.
Oh, you owe, $100,000. Well, why don't you put, this big pile of money over in your IRA, and then you're going to pay much less. And so it makes us look good, right? Because people evaluate their CPA on how much money they got back that year. But what they're not doing is not looking back. They were just kicking the tax can down the road. And so that opened up my eyes. And then he recommended the book, Becoming Your Own Banker, right? And which really talked about the infinite banking concept. So what I started doing is I kind of combined the two. And I wasn't planning on making this a business. I was just really doing it because I thought it was the best for my family. But then my clients would come as, "Hey, Anthony, I don't really trust Wall Street. What should I do?" "Well, this is what I'm doing. Why don't you read this book?" And then eventually I started, got licensed and started helping people incorporate those. And eventually Cameron and I, we had worked together for almost 14 years, but then we eventually decided that we wanted to start our own firm. So we left where we started, and that's where we started Infinite Wealth. And I know there's a lot of IBC people out there, but I would say what makes us different is that we incorporate infinite banking with Rich Dad Poor Dad. Our goal is, like with a lot of your listeners, they want to buy real estate, or really what they want to do is they want to create wealth outside of Wall Street. And ideally, maybe they're looking for that passive income. So we combine those two strategies to help people create financial freedom, which we define similar to Robert Kiyosaki, where our passive income is bigger than our monthly expenses.
Right. Yeah. Fantastic.
Cameron, you still awake? I know. I went a while.
Keith, I fell asleep over here. I don't know about you. I fell asleep.
Keith is on the edge of his seat.
I fell asleep at the 6-minute mark in that introduction. Wow, that was, man. And he won the second grade science fair. Did you talk about that, Anthony? Shit. That was good.
Yeah, that is good.
It was a spelling bee, but
why don't we maybe start with, I think, as we talked about at the head of the, just a little bit before the show started, most of our guests are high income W-2 professionals, and, they know about their 401k, they invest in their 401k, they have the company match. But why don't we just go ahead and start with why that's the worst financial vehicle for financial freedom?
Go ahead, Mr. Accountant.
Okay. So what we need to do is, how are we defining financial freedom? Right. And, again, we follow a lot of Robert Kiyosaki, and just I mentioned earlier, passive income more than our monthly expenses. Mm-hmm. When we abbreviate that passive income as pie, that we want our pie to be bigger than me. And so to create passive income, 401k is extremely difficult to do that, because you really can't access or tap in to that any of your gains until you're 59 and a half.
Right.
And which is okay for some people. If you love your job, then maybe waiting until you're in your 60s to retire is totally fine. Right. But there's a lot of people that aren't happy with it, and maybe they don't feel secure because they're going to see some layoffs and some things going on with the economy. So we always recommend people have some money that's liquid. So when life happens or when opportunities occur, they are able to take advantage of it. And with the 401k, there's so many restrictions to it that, for one, we can't use it to create passive income. And also, I think the 401ks are overused, particularly if there's great tax advantages in real estate with the ability to leverage and the depreciation, and the tax advantage of it being a long-term capital gain. When we put it inside a 401k, first of all, 401k is going to limit what you can invest in. But if you're able to roll that over into a self-directed IRA, then you can invest in real estate. However, we're going to lose all of those tax deductions. And in fact, we did a podcast and we actually did the math to show is that buying a real estate inside your IRA versus outside, and we took into account the tax advantages, the amount that you can and the amount that you can leverage. And because of the restrictions inside of IRA or 401k, when we did the math, even taking the money out, paying the full taxes, 40% plus the 10% penalty, because of the tax advantages and the ability to leverage, you are able to increase your wealth more by taking that money out of your 401k and investing in it directly.
Wow. Okay.
Keith, I might add. Yeah, what I would add to that is that right, if you look at somebody that let me say it this way, is in my experience, right, what people typically do is they start their industry or they start their career, And then 30 days later, HR pulls them in and says, hey, we've got a great opportunity for you. Right. And they start contributing to that 401k plan. Right. And that's fine. Right. We applaud people for putting money away. But the issue that I personally have, and I think it can speak for Anthony, is that there's no education that comes along with that. Right. And so what happens is people get 5-10 years down the road into this thing. And what they realize is they've got a large majority of their wealth is locked up in an account. 1, they can't access. 2, they have no control over. And 3, it can't create any sort of cash flow for them. And so there's this uneasiness that comes along with that. And that uneasiness just grows like the longer they're in it. Right. And so what we've done the last 14 years in our careers, we just come along, we give somebody an opportunity to reallocate some of those assets into an account that's designed for control and certainty. And then depending on someone's skill set, depends on what we're going to go invest in. Right. So maybe they got a skill set that is better used in a business and building a business or buying one. Or maybe they've got a skill set that allows them to go build a real estate portfolio. Right. And so that's kind of the process that will take somebody down.
Yeah, that's great. And you mentioned having a little bit more flexibility with the money, which I think is important. I look at that all the time. I've got a 401k, and I just found myself, because I'm trying to get a deal closed, and I'm like, okay, I got this money sitting there, right? And looking at, even if you do the emergency type deal, I mean, the person that's holding the 401k will hold on to an excessive amount of the fees until I'm sure probably till you pay your taxes or whatever it may be. But yeah, you don't have the flexibility. And then, as you mentioned, you also, even if you put that in a self-directed and you have somewhat of a say as to what you're investing in, you can't invest in your own deals. So if you're somebody that likes real estate like myself, you're going to have to invest in other people's passive investing opportunities and not be able to really kind of control and drive that. So really, really interesting stuff. What do you think are maybe can you maybe explain the overall concept of infinite banking and what is the vehicle that allows that to happen, and just really kind of get into how you consult with your clients on it?
Where we like to start with is we call this the cash cycle of investors. And what we found with most investors, they need capital to invest in these assets. And in between deals, they need to store them somewhere that is safe and liquid. So when an opportunity comes, they they withdraw that money and buy the asset. And then that asset is producing some cash flow, or maybe if we're flipping a property, there'll be some future profits. But when we get those future profits, we got to put them somewhere. So we typically put them back in a bank, right? Because that's what most people use for that liquidity and safety.
Right.
And then they build up more to buy asset 2. And they buy another asset, and that cash flow has to come somewhere, and they put it back into their bank account, and they just continue that cycle. And we don't want to disrupt that cycle or what you're doing. We just want to change how you're doing it, because that capital, it has to reside somewhere.
Right.
But so instead of using a bank, another option is a specially designed high cash value whole life policy. Now, I do want to stop. When somebody first explained this to me and they mentioned whole life, I was like, all right, that's terrible. Terrible investment. I heard all these things about it, right? I heard all these opinions about it, right? But at this point, I was open to focus on facts and not opinions. Because the reason why we use whole life insurance is because it is just as liquid as a bank. And I would even argue that it's safer than a bank, particularly as we're seeing some of these large banks failing now. But in addition to that, it's going to earn much higher rate of return. That return is going to be tax-free. Depending on what state you live in, if you live in a great state like Texas, 100% of the money of your cash value is protected from lawsuits. So if a renter or a flipper or somebody sues you, they cannot attach to the money inside your policy. But the biggest advantage on why we use whole life insurance is because we have the ability to leverage versus doing a withdrawal. Because when we take a withdrawal from our bank account or withdraw from anywhere, we're breaking the compound interest curve.
Right.
Now, Keith, at what point do you want your money to stop compounding?
Never.
Okay. Good answer. Right. The problem is when we're using a bank, we're breaking the compound interest curve every time. Every time we take a withdrawal, we break the compound interest curve. But with whole life insurance, we can do a withdrawal, but we can also leverage against it where we take a loan against it. And the advantage to that is your policy or your cash value continues to grow, to continue to compound even while you are using it. And I like to say it's similar. Keith, do you use a rewards credit card?
I do. Yep.
Well, why do you use rewards? Why do you add that extra step of a rewards credit card and not just pay cash?
Yeah, because I travel a lot for work, and it allows me to do the family vacations and all that with the points. We can usually, and you get the status, obviously, of being a platinum elite and all that good stuff, which allows you, to be able to upgrade to suites, all kinds of good reasons. So
late checkouts. Yeah, I'm with you. Yeah. If you can understand why people use a rewards credit card, you can understand infinite banking, right? We have and I'm probably at fault to it quite a bit. We get too detailed, too much in the weeds. But if I view my policy as my rewards credit card for my investing. Instead of just like using a rewards credit card, you add that one extra step, a credit card, but instead you use a policy. Mm-hmm. And then instead of getting miles and points, you're getting uninterrupted compound interest.
Interesting. And tell me a little bit about, so if somebody comes to you, and obviously there's a way to buy a policy with a set amount of money. And my understanding, and you guys are the experts, so you can correct me if I'm wrong on this, but my understanding is that you have the ability to pull out most of that as a loan against it from day 2. I mean, I don't know how long it has to stay in there, but I guess give us a little bit of an example of, how much you have access to right off the bat.
There's a bunch of different designs, right? So you can do this many different ways. I'm going to give you maybe an example of 2 of them, right? One of them is somebody comes in and they say, hey, I want to put X number of dollars in monthly, right? Just consistent, steady contributions. Mm-hmm. And what I would tell you there, just to talk percentages, is there's 2 parts to a policy. There's like the base premium portion, which is going to be the old school insurance piece. And then there's also the PUA rider, which is going to be the cash portion. So on the design, what we're trying to do, Keith, is we're trying to minimize that insurance piece as low as we can, and then maximize the cash value piece to it.
Right.
So if somebody comes in year 1, we're paying premiums. I would say roughly 30% of whatever they pay is going to go to that base premium. And then 70% is going in as PUAs, which is going to drive that cash value. So whatever number you want to use for premiums in that first year, roughly 70% is what's going to be available for someone to turn around and borrow against. And what I would tell you is if they just paid an annual premium right up front, is 30 days later in that first year, they'd have the ability to borrow against it immediately. Right?
Yeah, nice.
So that would be one caveat. And then the second year, what you'll see is someone continues to make those premiums, that disparity between what they're putting in and what shows up as cash value actually gets smaller and smaller. And so by that 3rd, 4th year, when they pay a premium, the entirety of that premium shows up as cash. And then from every year after that, they have an annual increase over and above or greater than what they're putting in there. So what Anthony and I refer to that as is like your slow start. So you're going to have a piece of that that's going to be the cost of insurance the first couple of years. But man, once you hit that third, fourth year, you've got guaranteed annual increases year over year, every year, as long as you have that policy. So that would be one pretty static example.
Mm-hmm.
Another one that I would give you is a lot of times with real estate investors, maybe they're exiting an investment and they just have one big lump sum of cash.
Right.
We do have a design where somebody can just dump it in there, and we've got a design, we call it the one and done, but they'd have access to greater than 90% of what they started with to turn around and borrow against immediately. And again, that's about 30 days later. So somebody comes in with 100,000, they dump it in there. 30 days later, they're borrowing against leverage in 90,000, and they're moving right back into that next investment. And then you've got that 100,000 kind of in the background working for them, continuing to grow and compound year over year.
Fantastic. And then what about, so if you're taking, let's say you take the one and done approach, just kind of working through this example with me. And, you're able to pull out 90% of it after 30 days. You put that into another investment, say. Are you paying yourself back interest on the money that you've pulled out? Or how does that work? And then are you earning interest on the money even if you've pulled it out and put it into a totally different investment?
Yeah.
Well, I would say when you take a loan out, again, you can take a withdrawal, which we're breaking the compound interest curve,
right,
or we can take a loan. And what is interesting, when we take a loan, it's not from your cash value, it's from the insurance company. And they're using your cash value as collateral. So this is like an ever increasing line of credit.
Okay.
When we take a loan, this is very different than your typical loan, because most times we get a loan from a bank, they're going to ask you, what is it for? How are you going to pay it back? And then you have to qualify for it. And then it's going to be reported on your credit. With these types of loans, you're automatically approved. There is no qualification. There is no required repayment terms, and it is not reported on your credit. Now, when you take a loan, there is going to be an interest rate, because we're not taking the money from your policy. We're taking it from the investment arm of the insurance company. And so they need to put that money to work.
Right.
So and one way they're put it to work is a policy loan, because to them, that is another form of an investment. And so those loans right now range between 5 and 5.7.
Okay. Yeah,
now,
very reasonable.
But you also have to thank you. Yeah. Now you also have to realize, since we didn't take the money out of your policy, the money is continuing to grow. So we have that money continuing to compound when the loan you're repaying is probably going to be at a slightly higher interest rate, probably by about a point or less. And what a lot of people think, wait a minute, I'm losing a point, right? But you got to look at the numbers, right? Maybe there's a point that we're missing, but we need to look not at points. We need to look at dollars. How much are we compounding on an increasing level, and how much interest are we paying? But that is on a decreasing level. But in addition, when you use a policy to create taxable income, like let's say to flip a property or to buy a property or to buy a syndication or whatever that investment is, we can deduct the interest we paid against the income we received. So let's just say the interest rate's 5, okay? And you'd mentioned a lot of your audience are high income earners, so they're in a high income tax bracket. So maybe that 5%, maybe it's only really costing them 3% after the tax deduction, but their policy is growing, let's say at 4% tax free. So there is that arbitrage there. But really what we look at it, we want our money to continue to compound even while we're using it.
Okay. And so
Keith,
go ahead. Sorry.
I might add something right there just to emphasize kind of that scenario. And I would say that that's probably one of the biggest education pieces that we spend with clients, is in that piece right there that Anthony just went through, is because conceptually a lot of people, it just doesn't register with them. right? Most of the time, if you talk about paying interest on anything, they think that paying cash is the best option.
Mhm.
If there's somebody out there that's listening and you have a question on that, call us. We'll walk you through what we call the borrowing strategy, where we'll actually isolate how much you're earning versus how much somebody is paying in interest. And if you take that over a 5, 10, 20, 30-year timeline, man, the numbers are drastically different. There's a huge difference in what you're paying versus what you're earning. And that's really what's going to separate somebody from operating on a cash basis. So really important piece that I didn't want to miss over there.
Yeah, and just the fact that I love the idea on this as being something that you have the ability to still earn interest on it, and like you said, have that compounding effect. You can pull the money out. You don't have to clarify with anybody what you're going to be using it for. And so putting money into something like this versus a 401k just gives you a lot more flexibility. And there's the insurance side of it as well, right?
Yeah, we didn't even talk about death benefit.
Right.
Right. And in part, because that's not why we're doing it. We're designing this policy very different. Not for death benefit. We're designing it for as much cash as we can get there as possible. And there is going to be a death benefit, which is just icing on the cake.
Right.
So either maybe you don't need as much term insurance, so we can save some money there, but also you're going to have permanent death benefit. Now, when we're in our working years, nobody's thinking about the death benefit and our legacy. But you talk to somebody in their 70s and 80s and 90s, and their goals are changing, and they wish they would have been able to provide more of a legacy. And that's one thing we help our clients with, the legacy, but not just dollars. More importantly, it's sense, right? That financial sense. We need to teach that next generation how money works. And it gets difficult when we have high income parents, and sometimes it's hard to pass down that work ethic when the parents have some wealth. So that's one of the things we're passionate about is helping teach the next generation financial principles.
One question on that. So let's say somebody has been doing this and this infinite banking, and they've built up, over the course of their life, X amount, a substantial amount because of the compounding. Are there any tax benefits to the beneficiaries, like the children of the people? And, how does that transfer? How does that wealth transfer within the policy?
The tax benefits is that there are none, right?
There are no taxes.
Yeah. Is you've got a death benefit, $8 million, $5 million, to whatever the number is that transfers to the next generation 100% tax free.
That's awesome.
Right. So if you're talking about wealth preservation and legacy planning, there really is no better tool to that. You'd mentioned something earlier about how this strategy gives you more flexibility. I would also add there that it gives you more control.
Mm-hmm.
Right. If, for example, right, as we talked about flipping homes previously, we've got lots of clients that will tap into a policy and use cash value to fund a flip. Right. Mm-hmm. So they'll take a loan against their cash value and they'll put it in there for the renovation. So they might have $50,000, $60,000, $80,000 outstanding for 4, 6, 7, 8 months, whatever it is. But there's no requirement to pay that money back. So while they have that loan outstanding, they control that whole scenario. And so they don't need to make a single principal interest nor make a principal payment while they have that loan outstanding. So a lot of clients will take that, have the money outstanding. It's out for 6 months. Once they turn that property, they take the proceeds and they'll put it right back into that policy while they're waiting or to acquire that next one. And so the amount of control that somebody has over their own dollars and the cash flow from a business perspective is phenomenal.
Yeah.
Let me add one more aspect on the tax benefit. And mainly, if we go back to the rewards credit card example, this is like cashing in your points. Right? You are going to buy, or you're traveling, you're going to do this thing anyways, but you accumulate those points and then your family can enjoy them with vacations.
Mm-hmm.
Now, when we relate it to investing, we're going to buy these assets or the investments. We're not changing that at any way. We're just changing where you're storing the capital in between deals. But what's going to happen, because we never break that compound interest curve, cash value is continuing to grow. And when you want to wind down, maybe you want to stop putting money in the policy, start taking it out. Because it's life insurance, we can take the money out and create tax-free cash flow in retirement. And I say that that's like your credit card points, right? Because we're going to buy these assets anyways. Right. So we have the assets, but by running this through the policy and incorporating the infinite banking concept, our credit card points end up being a tax-free cash flow in retirement.
Yeah, that's a good point and a good distinction. Even from the traditional, like going back to the traditional 401k, a lot of times we build this up, and the whole concept, which is kind of against probably a lot of the folks that are listening to this. I mean, you hope that when you get to that retirement age, that your income's actually higher. Right. And the 401k is built so that it's the opposite of that, you're going to take out just a small portion each time, but you're going to get taxed on that. And with this, it sounds like you can take it out and you're not having to pay any kind of taxes.
Exactly. And we are bad mouthing 401ks, right? But they do have their place.
Yeah.
Right. Particularly if you have a match, and particularly for high income individuals, I think there's more advantages than if somebody is in a lower tax bracket. So we have a lot of clients that do both, right? They have money in their 401k,
mm-hmm.
but they're also doing investing their own. Then we also have a lot of clients that have cashed out their 401ks. And we're just really rolling them over into a policy, and now they're starting to invest in some tax advantaged investments that also create passive income. So what we do is we view ourselves as educators. We're not going to tell you what to do. We're going to explain what you can do, and you got to make that decision on whatever is right for your family. Our goal is just to kind of help point out some things that maybe you didn't think of.
Yeah, no, that's a great point. And kind of going back to what Cameron was saying about the flip example, I thought that was really good because if I'm hearing you correctly, you're not having to pay any kind of a monthly payment while you've got that money out. And then once you sell the property, so there's literally no holding cost. Which sometimes can be a problem, especially we talked a little bit about my timing of getting into flips. And, I'm always concerned about the holding costs because it may take a little longer to sell. But this sounds like a great solution for that. And then I also look at like my 401k, right? And if I can take a loan against my 401k, but I'm immediately having to make payments again out of each pay period to repay my loan. And you're capped at the amount that you can, and there's a hold period. You got to wait a year.
Great point.
It's like there's all kinds of stipulations.
And yeah, there's a lot of ands. You're right. I mean, just like what Cameron had talked about, we want to have control. And particularly if we're a real estate investor, if you get a good deal, the better the deal, the smaller the window.
Yeah.
Right. Because somebody else is going to take advantage of it. So that's why these clients that I had referred to earlier in 2008, they had access to capital. So they were the ones buying your neighbor's house for 50 cents on the dollar.
Right.
Because they were in a position of liquidity. Right. But if you have your money, too much of it in a 401k, you're limited on how much you can get access to. But typically those opportunities typically happen when the market's down.
Right.
Right. So then it's kind of a double whammy. We're paying these taxes and we're selling it at the least opportune time.
Yeah, that's a good point. And the other thing that happens in a situation like we're in right now is that capital in general to be able to get loans tight, especially right now. It's just completely tightened up. I actually have a deal that I was trying to get some financing on, and I'm having to go back to the owners. Thank God they're willing to do the owner carry on it. They didn't initially think that they would be willing to do that. But when I came back and I said, hey, this needs so much work that no one's willing to lend on it until I stabilize it. And so it very interesting. It tightens up during this time, and this is when the opportunities come up. So great opportunity to use something like this.
Banks only want to loan you money when you don't need it.
That's right. That's right. For sure.
Right. So we need to have some money that's liquid. We need to get our lines of credit and our HELOCs when times are good.
For sure.
Like I've got mine, and we recommend our clients any lines of credit you're eligible for. Let's go ahead and qualify for them now. So that way, when these opportunities come, or when the banks tighten up, you're going to be in a position of liquidity, so you can take advantage of those opportunities.
Keith, to add on to that is you'd asked kind of what the insurance companies are borrowing at, right? 5 to 5.7 right now.
Yeah.
For the last 10 years, interest rates have been the lowest they've ever been. And so some of the messaging that we were telling clients was, man, take all the bank's cheap money right now for financing, take those profits, fund policies, right?
Mm-hmm.
And then leverage the cheap money. And now as that pendulum swings, right, the other way, prime's at 8.5. Well, great. Now all our clients are tapping into their policies at 5, right? 5.5 for opportunities that they can act on now. And interest rates are never going to be static. They're always going to move. So, right, the pendulum will swing back at some point. Maybe we start using the bank's money then, right? So just the ability to have options available to you is key.
Yeah, for sure. How about one of the things, bullet points on y'all's bio was, 3 reasons typical financial advice is flat out wrong for most investors. Why don't we dive maybe into that as well?
For one, I think that 401ks or typical financial advice creates lemmings. Meaning, I remember playing Lemmings as a kid on my Commodore 64, but
I don't remember that. You're old.
Cameron is younger, right? But really, a lemming is a rodent that's known for following the leader literally off a cliff, and that's what I feel. Typical financial people who take that advice, all they're doing is following what their financial planner said. They're not learning anything. They're not making the decisions. They're relying on the head lemming, which can be fatal.
The other point that I would add in there is the difference or the distinction between net worth versus cash flow.
Yeah.
If you talk to somebody, a traditional financial planner, their main focus is on net worth, right? They're trying to build this big net worth up as big as somebody can get it. But there's a big difference or disconnect between cash flow. Keith, the main conversations that we have with clients right now is around savings. Hey, what can you save? What can you put into a policy? But once you build that policy, everything transitions over into investment opportunities that create cash flow for somebody now today. If you talk to somebody long enough, what you'll realize is that, hey, they have goals, right, that they want to achieve. And all those goals are typically them going doing something else other than working. And so for them to go do that is they do need income. And so we dial in on what is your monthly income number? What do you need to be able to live life, retire now? And so that emphasis on cash flow is probably one of the biggest distinctions between traditional planning and what we're doing, right? Is Anthony's wearing the shirt, passive income greater than monthly expenses. And our podcast, right? Every other episode is us interviewing somebody about investment opportunities that create cash flow now today. And so that's the emphasis between kind of what we're doing versus what somebody else. So that's a big difference and a big distinction. I don't know if you have one, Anthony, but the other thing that I would say is on the education piece. Mm-hmm. That's probably my biggest complaint with 401ks is you can go into a lot of the ands that we talked about, like you can't do this and you can't do that. But really it's the no education, right, that comes along with that. And man, I tell people all the time, nobody's going to do it for you. With a 401k, really the the conversation that's being had is that people are being told that they're not smart enough to be able to manage their own money. Right? Is you're not smart enough to do it, Keith. Give me your money and let me go manage it. Come back in 6 months and I'll tell you how it's doing. And I don't know about you, but there's not a single instance in my life where I've outsourced something and it's gone like I wanted it to go.
Yeah.
Right. And so I think it's naive for people to think that they can outsource that and that they're going to be the most efficient they can be. And so the messaging between financial planning and then kind of what we're doing here is, man, you need to take control of what you're doing. And then there's going to be an education process on all these opportunities. We're going to find one or two that are a good fit for you. And then you're going to act on it, right? You're going to take action like Anthony was talking about. And we're going to go put it into effect, right? And then maybe the first one's not a home run, but man, that second one will get a little bit better. The third one will get better. And so I hope that helps a little bit.
Yeah, for sure. For sure. And let me ask another question maybe on the policies. You mentioned the kind of the one and done and then another option of being, putting in a monthly amount is, can you do a combination of both where you front load it with, a big down payment and then making payments along the way to continue to build it up quicker?
Absolutely, Keith. Most of our clients, right? Most of our clients will come to us and they've got kind of a cash savings, right? That they acquired and that they're holding on for some reason, right? They're just keeping a checking account. And then they are also saving on a monthly basis. And so you're exactly right. We'll actually set up two different policies to accommodate each source of funding. So one and done, we'll do that one. And then we'll also set up to accommodate monthly cash flow. So yeah, great point.
Okay. And then what about, if you are going to put in an initial deposit, is there a minimum, or what is what have you seen that makes the most sense for somebody that may have, I don't know, $40,000 sitting in an account and thinking, well, maybe this would be a good idea to at least get one of these started?
The way, as I said earlier, we don't tell you what to do. We tell you what you can do.
Okay.
And so we educate on how and why this works. And whatever number you feel comfortable putting into your policy is the right number.
Right.
We're not going to tell you need to max it out, or you need to, we're not going to tell you what to do, right? Because this concept is different, right? So you need to feel comfortable. And we tell people all the time, start slow. We just want you to try this out.
Yeah.
Right. And then you can find out for yourself on whether this is for you or not. But really, it's going to boil down to their goals and what they're trying to accomplish. And one thing we need to realize, that this isn't an either or. This is what we call an and asset. We're not saying put your money in life insurance or real estate or the stock market. I mean, this is an and. You got to store your money somewhere. You can put it in life insurance and leverage it for real estate, or put the money in life insurance and leverage it to buy stocks. Yeah. So really what we're just trying to do is open people's mind. And then we want them to come to the decision on what they feel comfortable putting money in. I would say for me, again, I have experience and I've been doing this for a while, but I leave about 1 month of living expenses in my savings account. I mean, I have a reserve fund, but I want it to be safe and liquid. But I also wanted to be protected from creditors and to grow and not to break the compound interest curve. So for me, I keep 1 month outside of a policy in somebody else's bank. Everything else is going to be protected inside one of my policies. I mean, so I'm an extreme, but wherever you're comfortable with is going to be the right answer.
Keith, maybe more direct, is it if there's a minimum or a maximum? No, there's not, right? Is you can put as little few $1,000s into kind of a PUA on a policy, but you can also put up to as much as you want in a one and done design. I think 5 million is the most any one carrier will consider, but you can go to multiple carriers.
Okay.
I was talking to a company earlier today, right? And they're as a business point of view, is they're sitting on $1 million of cash. And we're looking at taking that $1 million and dumping it into several one and done designs for their key executives. And then the plan is to turn around and take over the financing of the equipment that they're purchasing. right? So they're looking at buying a $700,000 piece of equipment. If we just redirect that cash flow, it's 200 grand. It's over $200,000 over the next 6 years.
Yeah, that's incredible.
Yeah.
And what about, are there any breaks as far as, is there like the more that you put in at one time, is there a better rate, or is that just, it doesn't really affect it?
It's all relative, whether you had like one big policy or 5 smaller policies with the same deposits, it's going to essentially be the same.
Okay. Fantastic. What else should we know about infinite banking? And maybe if there's a question that I haven't asked yet that I should have asked, let's go there as well.
What you stumped us, Keith. But what I would say with infinite banking, if you're a real estate, if you are an investor, you need to look into this. Maybe it's for you, maybe it's not, right? It's not for everybody. But what some people might be thinking is, like, I don't want to go through that slow start like Cameron talked about, or I hear your whole life's terrible, or I don't need the death benefit. I just want to buy my assets. I don't want to go through all that stuff. Well, we've done the math, and part of our education process is we do a case study based on their numbers where they buy an asset using storing the money in the bank, and then they buy that same asset but running the money through the policy. And then we're going to see who has more money at the end of the day, and more importantly, why. And not only is that part of our education process when we meet a client, it's that video is also in our online course, which at the end we're going to give your clients free access to our course so they can take a look at it themselves.
Yeah, that'd be fantastic.
Keith, what I would
go ahead.
I didn't mean to cut you off, Keith. Yeah,
Keith was giving us a compliment, and you.
Well, he's giving you one. That's why I cut him off. I'm like, yeah. Enough of that. The thing that I wrote down was actually something Anthony touched on in his 45-minute introduction. So I'm sure most people missed it, but it was facts versus opinions. Right?
Yeah.
The one thing kind of being in this space for as long as Anthony and I have been in this is there's a big difference between facts and opinions. When somebody first kind of introduces or looks at this idea and they mention or they look at whole life and they mention that to their financial advisor, their CPA, you're going to get a whole bunch of opinions, right? Most of those are all going to be negative just because that's what's been ingrained in them. Very, very few times is anybody going to approach you with negative facts.
Right.
And so as somebody looks at this, I would tell them to be very good at distinguishing the difference between opinions and facts. And so the reason I say that is because when I read Nelson's book, I was blown away by some of the education that was in there. And it was really basic, really simple stuff that you can implement to make some really big differences. But I would ask people about it and you just get attacked, right? They're like, oh, whole life is stupid, don't do it, this and that. Mm-hmm. I'm like, okay, well, that's cool. But that doesn't answer, that doesn't rebuttal any of the stuff that's in here, right? And he's got numbers to back it up. And so again, right, as people kind of get introduced to this, it's not as bad as it used to, right? 15 years ago, nobody knew about using this stuff, but it's becoming more commonplace. But that's one thing that I would tell people is don't rely on somebody else's opinion. Do your own homework. That's why we give free access to the course so somebody can go in there and find their facts themselves.
Yeah, and I think it's important to recognize that, unlike a lot of, when I think whole life policy, I'm thinking of just the death benefit piece of the puzzle. And, this is a totally different, you're having less death benefit initially, if I'm understanding it correctly, but a higher ability to be able to pull out cash and utilize the higher cash value right off the bat.
Mm-hmm. Yeah.
So
a funny story, Keith, is I was in the meeting this morning with this group. There's 4 partners in there, and we get to the end, and one of the partners, she goes, "Oh, well, so what I'm hearing is whole life. Why can't I just go buy whole life somewhere else?" And I said, "Well, you certainly could." I was like, "But we just spent an hour and 15 minutes talking about strategy."
Right.
There's a big difference between just product and actual strategy. So take the time, make sure if you guys are going to do this, you work with somebody that kind of knows how to implement the strategy.
Absolutely.
Keith, as you can tell, I'm the funny one because I don't know. That was a nice story. I don't know if it was a funny story, but it was a good story. I don't know if it was funny.
It wasn't supposed to be funny. It's educational, man.
Right.
Yeah. Yeah.
How about how can people find out more about you? Maybe more about the education courses, and and you mentioned having something special for our audience here.
Yeah, they can find us at infinitewealthconsultants.com. And that's going to be our website. We've got everything that's on there. That'll take them to the podcast and then our social media links and stuff. But there, we've got a YouTube channel as well. Great content on there. But specifically, if somebody is interested, wants to get into the course, our thank you for kind of having us on, Keith, and a thank you for the listeners for sticking around towards the end, is I'll give you guys a free link that'll give you access to the course. And so it's going to be infinitewealthconsultants.com /the wealth flow / you put that in there. I'll send you the link if you want to add that in the show notes so everybody can just copy and paste. But if you guys go there, that'll take you to the course. Feel free to look around. Like Anthony said before, there's nothing salesy in there. It's just a whole bunch of kind of videos that are educational. And then in the bottom right, there's a button that you can click if you want to talk to us. So feel free to go in there, look around, and see if it's a good fit for you or not.
Sounds good. Sounds really good. Guys, I've enjoyed this. This has been great, and I appreciate both of you being on, and appreciate the humor from Tony and the not so. No, I'm kidding with you. How about I got a couple other questions maybe for you both, and you've already thrown out a couple books, but I always like to get a book recommendation. Something that you've read recently. Or again, maybe just kind of the book that you were talking about earlier. So just good book recommendation.
So Cameron, he's not talking comic, but I would say,
is that a joke? That was terrible.
No, that was good. Keith laughed. A book that I read recently that I've been incorporating, it's really been helpful, was called "Buy Back Your Time." Dan Martell or something. I don't remember the name, but what made this different is what a lot of people, when the entrepreneurs, when they want to scale their business, they typically might go and invest maybe in more salespeople or specific areas. But what he says is what you should do is focus on buying back your time, meaning what are some things that you don't like doing and that drains your energy. Find a way to delegate that out. And then that allows you to focus on more things that fills you up energy. And that is also more productive. And what this book also has is some tactics that you can incorporate to help you do it.
Fantastic.
The book that I would recommend, Keith, is the one I referenced earlier. It's called Becoming Your Own Banker by Nelson Nash.
Nelson Nash.
This is the book that my real estate broker recommended me 16, 17 years ago. And that is the how-to on how to implement this idea or this strategy just at a personal level. So the gentleman that wrote it, Nelson Nash, it was published in 2000. And I couldn't tell you the number of times that I read this book, but I've read it more than Anthony. It's right. So if somebody gets it, right, you got to read that book. That's really going to change their mindset on personal finance, but also it's going to give them kind of the step-by-step process on how to do this at a very small personal level.
Okay. I got one more question for you both, and you guys can each take it or it can be a combined answer. But what about somebody who's maybe just starting out in their investment journey? What advice could you give them?
Oh, I got it.
Go for it.
This is probably one of my favorite ones, Keith.
Then I'm going to take it, Keith. What I would tell them,
what I would say is that this is one of my biggest gripes with our industry. Is our industry misuses words a lot, and I tend to believe that I've been here long enough. It's actually a little bit malicious, right? Is that they will use words interchangeably, and they mean something drastically different. And the three words that I'm referring to, number one is going to be savings, investing, and then speculating. Right? If you hear people talk about, hey, you got to save some money in your 401k plan, that is not savings, right? if you look at savings, by definition, in my opinion, it's the act of saving. It's taking money from one place and then actively putting it into another.
Mm-hmm.
And the idea of investing is there's a level of due diligence and education that's got to take place before you invest. And so investing means that you've got a very high likelihood of a certain outcome. And if you look at speculating is just putting money somewhere and just hoping and praying that it turns out for you. 90% or more of people are all in that speculative piece. They have no idea, A, what their money's doing for them, A, if there's going to be any sort of outcome. They're just hoping and praying. And so if somebody's just getting started, I would have you understand and know the difference between those three words and then be able to identify them as your pitch different opportunities along the way, because they mean drastically different stuff.
I think that's great advice. Thanks.
Keith, what I would add, it would be three things: is get educated and think long term, and most importantly, take action. Those first two things, or none of this education really means anything unless you take action. But you got to get in the game if you want to play. And you know what? Your first game is you're probably not going to perform well. You're going to be you're learning the game and how things go. Don't worry about that first game. Let's worry about that next game and the championship coming forward.
Yeah, exactly. I agree completely. Guys, great advice to leave the audience with, and it's been fun. I think you've added a ton of value for our listeners, and hope everybody goes. If you give them one last time, kind of leave them on where they can go to get kind of the free gift there.
Yeah, infinitewealthconsultants.com/thewealthflow. Again, I'll send it to Keith. It'll be in the show notes, but that'll get you to the landing page, free access to the course. Hope you guys enjoy it.
Perfect. Thank you, guys. Appreciate it. Awesome.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.